Hi, I'm Kevin Flanagan, head of fixed income strategy at Wisdom Tree.
And I'm Jeff Weniger, head of equity strategy. And this is Minds on the Markets, where we go behind the scenes and beyond the trends to explore the forces impacting our markets.
Hey, everybody. One of the big aspects here driving overall sentiment in the markets, whether it's the stock market, bond market, currency markets, you name it, has been uncertainty. But Jeff, is there a certain uncertainty we may know about with the letter T it begins with, such as tariffs?
It's something we've been writing about. You talk to advisors all day. That's basically what Kevin and I do for a living. And you get a feel for street consensus on things. And I guess maybe just the older we get, the more gray our hair gets. You start to realize that there are a lot of people who are dead certain about things in markets, and you really should never be so sure of yourself. And this notion that tariffs will necessarily, with 1,000% certainty, lead to inflation, and it's not necessarily borne out by historical data. Sometimes there were periods of inflation after tariffs were initiated, but sometimes you had deflation. I mean, look at Smoot-Hawley, which is 1930. And we had profound deflation in the 1930s. So it's kind of a weird situation where people are saying, if A, then necessarily B. And it's kind of like, how many years have you been watching markets? Markets oftentimes end up disappointing or surprising.
I think, that is a crucial point for investors to focus on as we go forward, right? Because, okay, Trump gets elected, and what was sort of the student body right mentality? Higher budget deficits, increased supply in treasury land, more tariffs, higher inflation. And you're looking at things, and sometimes cooler heads prevail. You need to take a step back, and to your, I think, point, look at things from a different perspective, maybe this historical perspective. I mean, one aspect we're dealing right now with the U.S. economy is what we're seeing in the first quarter, at least in the month of January, maybe the beginning of February, was a potential surge in imports coming in order to avoid some of what would be considered the retaliatory type of tariffs we're seeing, and how that could impact U.S. economic activity as well. So, it's interesting. It's not just inflation. There could be economic impacts as well. But what I wanted to press you on a little bit more is when you do go back in history, like you just mentioned Smoot-Hawley, but we had some under George W. Bush. We had Trump 1.0. What did we find out during those periods?
Absolutely. And make sure that you're liking and subscribing so that you can catch us doing more of this in the future. Yeah, I mean, look, and this is something you and I have talked about off cameras. When you think about 2001, 2002, you're remembering September 11th. It was just the big thing in our own lifetimes that was dominating our own timeline up here. Bush did have steel tariffs in March of 2002. It was just kind of a forgotten thing. Nobody's really, .com was blowing up. Steel tariffs are forgotten by the annals of history. And after that, there was inflation. And you have to say, well, was it the tariffs that caused the inflation? Was that just a one-off? Or was it the fact that China had just joined the WTO back in 2001 and was ready to gobble up all these commodities in 2002, 2003, 2004? Nixon closed the gold window in 1971, put wage controls, gasoline controls, and a 10% tariff, and you did get inflation taking off. So it's one of these things you say, okay, well, are we going into a Smoot-Hawley hard deflation? Are we going into Richard Nixon hard inflation? I think you just have to have a little bit of humble pie when assessing these things and say, hey, I need to assess 10 or 15 or 20 different factors. It can't just be if tariffs, then X. It needs to be the whole comprehensive view.
Absolutely. They don't occur in a vacuum. And I think that's what people sometimes get lost in. I mean, even the Fed themselves, they've been highly data dependent and they're now, say, policy dependent. They become reactionary. Right. And this is all part of the equation for sure. So final question, though, before I let you go. What's factored in? Any thought of what could be factored in to, say, the equity markets right now?
Well, I think it's it's going to boil down to how much of this inflation does come through, because the street is looking for the Fed to be on hold for some time. But I think a Fed that's on hold is a generally confident Fed. I don't really want to see the central bank moving all over the place. Maybe the policy rate is at a satisfactory level right now. The stock market itself, we're still looking at if street consensus is correct, double-digit earnings growth, which should be satisfactory enough for a stock market that is on the pricey side, 22, 23 times forward earnings. But one of the things that's critical here, and you have to try to gauge, is it Jay Powell? Is it Donald Trump? Is it just the general market's internals? Is that year to date, call about 3.5 or 4% has been the outperformance of value over growth. So we are at least in the micro term, the last 30, 60, 90 days or so, we're in a little bit of a value cycle. See if it's the big one we've been waiting for, but value seems to be game on and growth a little bit ice cold.
Perfect way to end it, Mr. Weniger, for sure. That's it from here. But I have a funny feeling this topic is going to be the gift that keeps on giving for the next few years, for sure. Like Jeff said, please like us on YouTube. Check out, go if you need a written version to our website. Have a great rest of the day, everybody.